Chris. How are you? Ramesh Pakori here at the IRA Club.
I'm Chris Carsley, Chief Investment Officer for Kirkland Capital Group. As you can see, we're talking about due diligence, investment. Let's go in, let's figure out. This is where everyone spends most of their time. This is where most of the people will come in and say, hey, you should really understand most of the investment aspects. Not arguing, it's super important, but I'll let you know, and you'll see this factoid on one of the later sheets here, is investment due diligence is not actually where most of your failures occur. And especially if you're looking at smaller or emerging managers, you really got to make sure that, they have the other aspects. They have the operational due diligence in place. Does the team have the knowledge and understanding of how to run and operate a fund? Do they have the right business due diligence? And I'll go through and define all these in some later slides. And then lastly is some level of economic due diligence. I'm not a proponent, if you're a long-term investor, about timing things, but it is something definitely to consider of what is going on in today's world. And is it right to be looking at one investment or another for your portfolio? So we'll walk through, a number of those things. Investment due diligence, the exciting part of things, what cool things they're going to do. What are the fascinating investments they're going to put together to create an excess return? You've got to understand the market strategy. You've got to understand what instruments they're using, the risk behind instruments. Is there inherent leverage? A lot of different hedge funds use derivative structures. Okay, well, what leverage do they have inherent at the hedge fund level? Are they borrowing any money? And what's the inherent leverage of the instruments they're deploying? Okay, well, understand what kind of volatility can occur in those types of structures. If you're looking at, a hedge fund, if you're looking, at a venture fund, are they sort of looking across an entire spectrum? Are they specializing in one particular area of venture? Understand what they're doing. Educate yourself. If you don't know everything they're going, ask the questions, go Google it, try to get into a network that can help answer some of the questions about a various investment strategy you may or may not understand. If you don't understand it, and even when someone like the manager explains it to you, you still don't understand it, I kind of have a rule. Having seen a lot of things, if I can't really understand after the person who's supposed to know it inside and out tried to explain it to me and I still don't get it, it's probably a pass. That's one of my rules.
We understand that, me and you, better yet, understand that all investments have risk. It doesn't matter what you're getting involved in. And the way that I try to categorize it is, well, look at the stock market last year, right? So how much did your 401k, your IRA lose last year, right? 23% according to Fidelity, 19.55%. Your IRAs, 403bs lost just under 19%. So it doesn't matter. The point is every investment's got risk. What Chris is educating you on is calculated risks, right? Educating yourself first. And I love that you said that phrase, choose investments you know and understand. That's one of my models, actually. I say that all the time. If you don't understand it, don't do it.
Start with something you're passionate and understand. It'll help you 100%. Think through everything better. But your point is exactly right. And I know that goes on a lot nowadays and it's not necessarily anyone's fault, but this is just a fact of the universe. Most, financial advisors, RIAs, whatever you want to call them, wealth managers, for many, many years, you didn't need alternatives. They were always used by big institutions. They've been the primary purchasers. And I think 2020 was a little bit of a wake-up call that, okay, hey, traditional markets can have some flux and alternatives really can have a place within your portfolio, whether it be on the equity side or fixed income side. You're going to have those service providers in place that are looking over your shoulder, controlling things. Maybe, they're calculating the management fees. They're calculating the operating expenses. They're going through every last number that impacts an investor's capital account. I mean, for my fund, that's what my fund administrator does. I mean, they actually calculate everything, and I'm the one that runs the shadow books. They run the primary books. So that's one of those operational due diligence items that you can go in and understand. Hey, who are your service providers? What kind of control do they have? And who's watching you manage the fund? And so, one of my jokes is, yes, I'm the chief investment officer. I I'm involved in every decision of the fund, but myself, I can do nothing alone. Everything in our entire company is dual control. So that could be a point where you're going out and saying, hey, what is the dual control? What are the cash controls? Who can set up wires? Who can do these various things operationally to ensure that investors' capital is as safe as it can be? Next is business due diligence. And this sometimes throws people for a little bit of loop of, well, what's operational due diligence? What's business due diligence? Operational due diligence is all the operational people and systems and things in place that directly relate to whatever they're trading in. So you'll want to walk through trade systems on the operational side. On the business due diligence side, it's all the operational or structure in place that has to do more with the business and doesn't directly relate to the trade. Also, one of the things is like, hey, if they're in an office these days, I know that's not always common, especially in small funds. I mean, we run purely virtual. Now we do have an office in downtown Seattle that we go to every once in a while, but it's a shared access, open desk at WeWork. Most people don't need offices. So it's made some of your on-site due diligence a little bit and verification a little bit more difficult. But I still have had investors. They come in, they meet me there, and we open the computer and I walk them through spreadsheets and models and access to our lending program so that we can go through and, look at, loans in the pipeline. All kinds of different things for on-site verification can still be done in almost any location in some of these virtual companies. Code of ethics. This is kind of where it gets in the code of ethics and human resources. What is their plan? How do they operate that? Because one of the things that I know, having built a lot of small startups and things like that and worked with those people, there's a lot of human resource issues. There's a lot of changing rules and regulations and employment laws by state these days. So understanding some of that is super important. And then lastly, economic due diligence. And these are this will shift. And I just kind of grabbed what was kind of going on right now. Obviously, inflation's a big one. This is in everyone's face. It is something no one's really cared about for a long time, but it's pretty material right now. So how's that affecting your investment? What is the future outlook of, the investment dollars? If you have something that's making 4 or 5% right now, well, inflation is pretty much eroding that return all by itself, regardless of fees and taxes and everything else. So that's, one thing to definitely be concerned. Interest rates, we've had wars of recent and it's still going on. Count humans that once we're done with one, we'll probably find some idiotic reason to have another one. And so how is that going to impact that investment? Is it if you're investing in emerging markets and you're going to be finding something, in what might be a hostile area? Well, okay, that's something to be concerned. What's the political stability? What's the situation? Who are the trade partners in that area? Understanding what strife might hit a certain geographic area could be rather important to your investment, depending on what it is. So this is where I get into looking through and walking through these economic factors and how they will impact your fund. You'd be amazed. I mean, I love this part of the due diligence aspect because it's a little bit of like putting a puzzle together. And hopefully the manager can really walk through and has a deep understanding of what historically has hurt their trade or caused it to have excess volatility. So because a lot of trades are what they call cyclical. In certain types of events, they will do really well. Others, they won't. Long short hedge funds recently. I mean, they're having a heyday because I'm not going to go in, but what they call dispersion between longs and shorts. And, having that dispersion allows their book to have a wider spread and make more return. When everything's in utopia and everything's fine and money's free, well, there's not a lot of dispersion. So hedge funds for the last 10 years, some have done fairly well, but not as well as they've done historically when we had some volatility in the market and dispersion available. So, I mean, right now there's some uncertainty. So, and dispersion's back in the water. So, a lot of your long short equity funds are having, time of their day. It's better than the last 10 years. And then you got elections, strong dollar. Maybe you're looking, the dollar's been, very, very strong recently. Well, maybe your investments are in another currency and you're going to translate back to the US dollar. And it's something to consider. All right. Now the fun part, non-negotiables. This is where you're going to get into, and this is something you got to form for yourself. You've got to figure out, regardless of the investment I'm looking at, this manager or this investment can't be doing a certain number of things. This is going to help you identify a short list. And it doesn't have to be long. I mean, you don't have to, you have 30 non-negotiables. You're probably never going to find anything to invest in. So draw out your list and then figure out, hey, what's actually, feasible. And if I've got, 3 or 4, maybe 5 non-negotiables, no matter what happens, well, I can just skip over that fund as I'm reviewing that. And we'll walk through. I mean, some people gave me some stuff. Oh, hey, well, whatever I invest in has got to be first position. And some of these are a little bit more related to, real estate, because I asked, even some of our own clients some of these questions. They want to see, they're about preservation of principle. So they want to have nothing but, first position. I don't want to be sitting second fiddle to anybody. Something goes wrong, I want to be the only one at the feeding trough kind of mentality. And that's definitely, as the explosion of private debt. Yeah, there's a lot of mezz and a lot of other things that do certainly well. And I'm not saying they're not in bad investments, but most of what I've been hearing is people want to be definitely in first position right now. They want shorter term. They want a variable interest rate. Well, interest rate's been going up. So why I put those two together is you can kind of create a little bit of variability if you're normally doing short term. So like for us, we do bridge financing. So we'll have loans that, 8 to 12 months. Although the Fed did set a record of, raising interest rates, all in 1 year, 5%. That's not normal. And so historically and probably going forward, you're looking at a situation of where, if you've got a term of 6 to 12 months, you're very short term in the world of investments, and you probably won't carry a lot of interest rate risk. And so you'll be able to capture a rising rate as you roll into new instruments. They want it backed by real assets. You can see all these, in today's age, I laugh. If I asked this question probably 5 years ago, none of this would have probably come up because it was all about risk on how do we take as much risk and pump out the biggest return? A few punches in the face will get you to rethink about, what's important to you. And it's amazing how many people are about principal preservation and sort of risk management, risk controls. And they, a lot of people want to see core team success. They've been successful in other things. Maybe not, if it's a new fund, maybe you won't have a long track record, but often not people who are in the investment world will have been successful at other things. So that's something to think about. All right. Some of the questions that came up on fund managers. They want the fund manager to be articulate. They want to be able to demonstrate the differentiated opportunities. This gets back into can they identify what their inefficiency was? Can they understand how they're going to generate this excess return? A definable niche. One of the things I love also is everyone will want to talk about everything that worked. I always like to go after at least 1 or 2 things that didn't work. Everybody who's running something has had something go wrong. Anyone who says I've never had anything go wrong at all, well, you're the lucky of the person or you're full of it. So find that trade that didn't work. Have them walk through how they got into it, what was the analysis, how it broke, and then most importantly, well, how have they fixed it, or how are they still in the process of mitigating that risk and fixing that trade in one form or another. Unfortunately, in some strategies, when something breaks, sometimes in venture, well, that company's just out of business. And, the money deployed to that company is 0. So that's why they try to be fairly diversified. Obviously, in today's world, people are worried about recession. So one of the, these are real points brought to me by RIAs, wealth managers, people who invest in alternatives, and they run billions of dollars. They're very big, and these are the points that they threw back to me, and I just wanted to be able to share these with you guys. They want to say, well, hey, how are they going to be dealing with recession? How are they going to plan to navigate given their strategy? Have these people seen that market cycle? That's a big thing right now because for some people, you could have been doing something for 8 to 10 years, and you might not have actually ever seen anything break. This might be your first market cycle. Doesn't mean they're not going to make it or they're a bad manager. It just can create some undue stress that they may not know how to fix everything or have the answers, and that can be troubling as an investor in that kind of fund. And then one guy was like, well, this person won't be investing in my fund because I've only been doing this particular fund for about 3 years, but he required 10 years in the current strategy. Okay. Fund size. Does the manager understand its capacity? If you're generating an excess return, you're probably in something what they call a capacity constrained trade. I found a lot of these guys when one of my jobs when I was working at a fund to fund was to go find people that could consistently create alpha in a short book. And everyone, I think here, if you don't know what shorting is, you can go look it up. But I'll just be shorting is extremely hard. It is counterintuitive to how the human brain wants to work. So finding a person who can consistently do it is not that easy. And if you break down the attributions of, say, some long short hedge fund managers, you'll find that shorting has not been the best thing for them. But there are some people who create that, and they understand their capacity and they understand the niche of their trade. And I found one guy that was like, listen, I can't run more than 200 million. If I get over that, I really can't get the allocations of the shorts I want. Because it would just, there's just not, you can't borrow enough stock to meet a shorts. So do they understand that capacity? Because not all funds can go to $1 billion. It just doesn't work that way. And if you're running billions and billions of dollars, you're probably not in something that's too terribly inefficient unless you've got amazing networks and you've got amazing systems. And there are funds out there that have those, so they can still create decent excess returns with a fair amount of money. Those are fairly unique and they're pretty hard to get into these days. So let's move on. Personnel. In today's world, people want to see gender diversity. They want to see some level of who else is working there. I'm not going to lie. I mean, you go back in time, 20 years, we used to joke some of the hedge funds were, two guys in a Bloomberg. But people want to see a diversity of thought. It's definitely something that's pushed in venture and a lot of things where you need multiple eyes thinking about certain trades at multiple angles. Well, if you have all the same kind of people in one room, and they all graduated from the same college and they all have the same background, well, you're probably getting the same thought. You're not getting a differentiated viewpoint on whatever problem that might be in the portfolio. So having gender or race difference or background in education can be big. It's something you should look into and understand who are the decision makers and how are things being done. And one guy wanted to see that whoever launched the fund has had previous experience, success in other funds and other ventures. Money. Big one is transparency. If you can't get transparency, you really can't do your due diligence. So if you've got a fund that's really making it difficult to obtain information and being squirrely around the questions you're asking, well, maybe it's one of my big non-negotiables. I mean, if I can't get what I need, I don't have time to waste on you. Thank you very much. But in today's age, in my belief, you should be able to have the transparency and be able to look into a number of different things that are going to meet your requirements for due diligence. You've got to have transparency. You've got to have that third party involvement, like I was talking about earlier, having those people look into those numbers. That's all got to be, in place. His example here was, he's like, I don't want to buy into a portfolio, say a second close on a VC fund, that holds positions that should already have been, marked down. That's a current event that was going on. A lot of venture capitalists in 2022 and even into 23, not so much now. I mean, there's a lot of data that's showing that most venture capitalists have marked their portfolio down accordingly in one fashion or another, where it's necessary. Not all of their investments are going to go down given this current time period. A successful company will buck the trend of rising cost of capital. That's just a fact. But you don't want to go into something where, say this individual, a venture capitalist, hasn't marked its portfolio down yet. You're buying at a high book level, and you're going to walk into a storm of where they're going to have a lot of write-downs. I know that's causing some headwinds for people raising money for other funds in the venture space. In times of stress, everyone loves the leverage. I could go on about leverage. leverage has caused a lot of problem for people who don't really use it correctly or over leverage their situation, or, what I call get over their skis. I've used leverage in a variety of different trade structures. It's something you have to understand what leverage level is appropriate. It's what we get into where you're calling counterparty risks. Obviously, the leverage adds volatility, but one of the things that's going on right now with some lenders is they had a facility line that the banks are not really doing a lot of lending, and they're certainly cutting back on their lending lines that they had to other private lenders. And so that causes a real problem. So understanding what leverage they're using, and even asking for the document, saying, hey, send me the document of the facility from the bank, and what are the, can they just rip this thing from you? What is the process and procedure around that? What kind of leeway and notification time do you have where, you're running $20 million and you got 20 million in debt, and the bank walks in and says, give me my 20 million back. That's a material problem for any business, where you all of a sudden have to, in a short order, cut your business in half. That's a problem. Then you're dealing with a variety of different issues, regardless if it's a manufacturing company or a fund. So understand that, dive in and understand what they're using, but don't get into this like all leverage is bad. I know a lot of people have just been beat over the head with the clickbait big news that leverage is bad. Leverage is used in a lot of different aspects across a lot of different trading strategies. Where you need to know is, through the education of the investment strategy, where does leverage make sense and how much? And if you don't know that answer, that's where you need to go and expand that network and build that information base for yourself, so that you can hopefully answer those questions. This individual here was, I have to operate in a fiat currency. Well, he wants to be in US dollars. Okay. Or another major currency, euros, yuan, whatever. They didn't want to be in crypto. Which, I mean, at the time that I think I collected this information, it was a little bit before the crypto crash. So obviously this person was right. That probably was a smart thing to do. And that's there. I'm not saying crypto investing is bad or this or that, but there is more inherent volatility and issues in that structure than most people were thinking. And you might be looking down the pipe of saying, hey, there's going to be further regulatory actions against that area, to where it's all going to be considered a security, because they open that door with all these failures and frauds. So that's probably coming down the pipe there. So something to be wary. Independent marks. This deals with valuation. This is super important. How are things being valued? This is something you really need to understand, regardless of what you're looking at. How are they valuing a startup company? How are they valuing their books? Maybe you're lucky and you're looking at something that deals with all market securities, so they're marked, at a mid or close price on a daily basis from a reputable, public source. But a lot of times when you're looking at alternative investments, you're dealing with a private investment that doesn't trade in an open exchange. So you need to really understand, how are they valuing it, who is valuing it, and how that valuation impacts you. Does that impact fees? Does that impact the cost of my entry point? Does that impact if I needed to get out? If you're in a fund that has the ability, say, quarterly liquidity, how has that all worked out? So you need to understand, and are they getting independent marks? Because one of the things that has happened in the past is where, if you've got valuation being done by the manager, I'm not saying everybody is doing, crooked things, but it has been a recurring theme that funds that had trouble and they were misrepresenting to investors, often they were marking their own portfolios. So it's something to dive in and understand. Here's the problem with that, is you got to have a level of ongoing monitoring to that too. So what I told you in day one when you invested may not what I did be doing 2 years ago. So hopefully a major change in some type of process and procedure, the manager would tell you, but not always. So, there is a level of ongoing due diligence that's needed to keep up. And that kind of gets back to the transparency. How transparent And what type of information is the fund manager actually disclosing? And it's not always about the portfolio. Sometimes you want to, hey, did someone leave? Did someone come in? What's the changing procedure and operations in something? They should be having that in a newsletter or some type of quarterly update. I know we always talk about, any type of operational changes that we're, putting in place in our updates, because, we really want to be as transparent as possible. This person was, sin related industries, a lot of ESG issues. So people are looking at for, that environmental aspect and social. Obviously, if you did proper research, most of your governance will be covered in, operational assessments and business assessments, in the earlier sections. And you had one manager here. I just threw this in here. It's very, very idiosyncratic. He's like, can't support the privatization of prison systems. That was just their particular thing. So
Chris, thank you again.
thank you for
Looking
having me.
forward to the new website. Thank you, Ramas. Absolutely. Thank you, guys. Take care.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.